Hello and welcome. This is Vinay reporting live on the global gold markets. Today we're taking a close look at why gold prices have pulled back lately, what's driving them, and where things might head next for both the United States and the United Kingdom. In recent weeks, the price of gold has dipped from recent highs. For example, spot gold in the US fell to around $3,964 per ounce, amid improved optimism around US-China trade talks, which reduced some of the safe haven appeal for the metal. Another pressure point has been a stronger US dollar, which makes gold more expensive for holders of other currencies and tends to weigh on demand. And on top of that, markets are intensely watching the Federal Reserve, Fed, in the US for signals on interest rates. If yields remain high or the Fed holds off on cuts, that tends to dampen gold's attractiveness as a non-yielding asset. To understand the recent pullback, it helps to remember why gold climbed so strongly earlier in 2025. Analysts at Morgan Stanley note that gold has rallied nearly 50% in 2025, helped by heavy central bank buying, strong ETF inflows, and expectations of a weaker dollar ahead of rate cuts. In that environment, gold functioned as a hedge, a store of value when inflation, geopolitical risks, or monetary policy uncertainty were high. But now some of those tailwinds are moderating. With trade tensions easing, safe haven demand is lower, and if the dollar remains firm or yields stay high, gold loses some shine. For instance, one bank has warned of a target near $3,800 per ounce under a more cautious scenario. Reuters. Looking ahead, there are two potential paths. On the bullish side, if the Fed pivots to cutting rates, the dollar weakens and geopolitical or financial market risks flare up, then gold could resume its climb. Morgan Stanley suggests gold could rise toward approximately $4,400 per ounce by end of 2026. On the bearish or neutral side, if global economic growth continues modestly, safe haven demand wanes, the dollar stays strong, and interest rates don't come down quickly, then gold could stall or even retreat. For example, commentators warn of consolidation around $3,100 to $3,500 per ounce. For investors in the US, keep an eye on the Fed's tone, the trajectory of the US dollar and Treasury yields. These will be major drivers for gold's near-term moves. For UK investors, while the dollar's strength is relevant, as commodities like gold are often dollar-priced, sterling's movements and UK inflation/monetary policy also matter. The appeal of gold as a hedge may vary depending on UK-specific risks. For example, inflation, Brexit-era trade issues, or global shocks. So what's the takeaway? Right now, gold is under pressure because some of its earlier drivers are less dominant. But the longer-term case for gold remains intact if risk, inflation, or monetary policy tensions rise. If you're thinking of holding gold as part of your portfolio strategy, it may come down to your view of how global economic and policy risks evolve. That's the latest on the gold market. Thank you for tuning in from the US, the UK, and beyond.